Hi, this is Jack Duvall, CEO of Bantam Incorporated, a private investment office in New York. Today I'm doing a short video on cryptocurrencies and Bitcoin in general, with some side comments on the death of the 60/40 asset allocation. So, first thing, number one, none of this is individual investment advice. If you need advice, feel free to shoot me an email or give me a call. But as far as cryptocurrencies, it's my opinion that everyone should own some. The only question is really how much. For most people, the answer to that is very little. And whatever percentage that you own, it should be a percentage of your risk assets. So let's do a real simple example. If you have 50% of your investment assets are conservative and 50% are risk assets, then if you had a 1% allocation to, let's say, Bitcoin in your risk asset account, it would only be 0.5% of your total investable assets. And that's one of the ways that you can control the risk. By the way, I should mention that this video is accompanied by a blog post that I did last week, and I will post a link up in the comments to this video. So, a lot of people will say, well, cryptocurrencies aren't backed by anything, and that's true. But neither is the US dollar or the euro or the yen or the renminbi or any other currency. Basically, currencies, especially fiat currencies, are nothing more than a story that we have all agreed on. And this is actually one of the superpowers that humans have. We can agree to a story and it makes all our lives better because we've agreed to it. If you think about what a country is, we agree to live in a country and abide by the laws. Those laws are just an agreed to story that we have. Currency is the same thing. And as long as everybody believes in it, it works. You agree to accept dollars because you believe that other people will accept dollars for payment. It's that simple. The economists will tell you that currencies have three traits: store of value, medium of exchange, and a unit of account. Certainly cryptocurrencies have all those. I'm going to be doing a whole series, by the way, on cryptocurrencies, so I'm just trying to hit some of the high points here. I do want to touch on a separate issue, which is the 60/40 allocation and how that's probably seen its better days are behind it. And that's just because interest rates are so low, of course, engineered by the Federal Reserve. But the 10-year yield is now under 70 basis points. So basically that is a form of return-free risk. You don't get any real yield to hold it. And the risk is that interest rates could go up and you are long a lot of duration because the interest rate's so low. That's just a fancy way of saying that you have a lot of interest rate exposure. So if the rates were to go up, you would see your bond value go down and you would not be compensated by getting a high yield on it. So that's what return-free risk is. It presents a real problem. A lot of advisors have put people into what I'll generously call bond substitutes or bond proxies, such as utility stocks, such as REITs. And yes, those things do have higher yields, but they are equities. And if you look at what happened to those assets, those industries and asset prices during March, during the coronavirus sell-off, they went down tick for tick, if not more than, say the S&P 500. So it presents a real problem. A lot of advisors have pushed their clients out on the risk spectrum, and that could be a very bad trade. To tie it back to the cryptocurrencies, I think that cryptocurrencies and gold, by the way, are good alternatives to going into equity, bond proxies. Um, Certainly, it was small allocations on the crypto side. With gold, you can you can have more, and gold's been going up because real yields have been going down, meaning that the yields that you earn on fixed income are lower than the inflation rate. So even though you make a nominal yield on your fixed income investment, you can buy less groceries at the end of the year than you could at the beginning because the prices went up more than your interest rate or more than the interest from your fixed income. So I'm not suggesting that people take 40% of their money and put it into cryptocurrencies, but I think that they can offer true diversification, whereas those equity proxies do not. I hope that's helpful. Come back as I'll have more of these videos. Thank you for listening.